coupons and face value. We get periodic coupons, and on the maturity date we get face value. These are the cash flows. Then we need to know timing of these cash flows. These are the inputs that we need. The third one is the required rate of return. What is the return that we require on this bond? Later we call it as the yield or yield to maturity. So we should know these things when we calculate the price of a bond. Then how do we calculate the price? We have this equation. So each cash flow the coupon discount each cash flow discount using the required rate of return and this frequency. This F is the coupon frequency. C is the coupon for that period. This is the long equation. We can summarize this using all these coupon payments, considering all coupon payments as annuity, and use the annuity equation to calculate the present value of coupon payments plus the present value of face value, what we get at the end. So this is the basic we discussed last week about how to price a bond. Then later we call this R as yield to maturity under few assumptions. What are those assumptions? We assume the buyer of the bond holds this bond until maturity, and the yield will remain same. Therefore, the investor would be able to invest all the cash flows at the same rate for the remaining period of the bond. Under those assumptions, we call this as yield to maturity. That is the return the bondholder can expect if he or she holds that bond until maturity. And then we discuss the relationship between price and the yield. What is that relationship? If you look at this equation, when yield increases, what happens to the price? Price decrease. Why? When yield or the required rate of return increases, this discount factor increases. Then we divide by a larger number. Then we get a small figure. Therefore, when yield increases, price decreases. To earn higher return, we would pay less amount to buy that bond. But it's not one-to-one relationship, because it's a division. Not only that division, there are powers. the discount rate varying with the time. So therefore, it's not a linear relationship. It will be a curve like this. At the low yield level, price changes are higher than the price changes at the higher yield level. So the shape of the curve would be like this. These are the basics that we discussed. We are going forward today, especially to discuss this and this shape, and based on this, how can we estimate the sensitivity for a given change in yield? What would be the change in price? How can we estimate it? What are the ways? What are the ways to measure this sensitivity, and how can we use that measure to estimate the change in price for a given change in yield? That's what we are going to discuss today. So before we move forward, if you have any questions, please free to ask. I hope you can see the presentation. Can you see the presentation?
Yes, can see.
Okay, the topic is today duration and convexity. That's the duration is the so this is the recap what we discussed last week, how to calculate the price of a bond. Same thing, there's nothing new. Then the relationship that we discussed between price and yield. There's an inverse relationship. When yield to maturity increases, price decreases. Or when yield to maturity decreases, price increases. And it's not one-to-one or the linear relationship. It's a curve. Basically, we call it's a convex curve. So then, as I mentioned, how do we measure the sensitivity for a given change in yield? What would be the change in price? That sensitivity we call as duration. There are few definitions about duration. The very first one is this Macaulay duration. Macaulay duration, the definition is it's the weighted average of time in the weights are the present value of the cash flows. The weights are the present value of cash flows in this equation. Though there's no one written here, there's a multiplication of 1. In the second one, the term is multiplied by 2. This n is the last term. Say if it is 10 years, an annual coupon n would be 10. If it is 10 year but semi-annual coupon, then n would be 20. Likewise, you can see if you just consider this one, this is the present value of the first cash flow. Without this 2, C2 divided by this term, that is the present value of the if you just consider this part only, you would realize this is the present value of the second cash flow. This is the present value of the nth cash flow. So very similar to the pricing equation, but only difference is all these present values are multiplied by this number. What is this number? That is timing. So that's why it says it's a weighted average of timing weighted by the present value of these cash flows. And to represent it as a percentage of the price, we divide that term by the price. So this measures the sensitivity of bond price to change in yield. There are few definitions or the interpretations for this Macaulay duration. One, it says Macaulay duration estimates how many years it would take for an investor to be repaid the bonds price. So based on its total cash flows. But in practical speaking, we won't use this definition very much, but instead we'll discuss another definition about duration called modified duration. It is very easy to interpret and there's a practical meaning of it. So this is the definition of Macaulay duration. It is nothing but it is a weighted average timing of the bond. Weights are the cash present value of the future cash flows. Each timing is weighted by the present value of that cash flow. So the other way that we can look at that Macaulay duration is the balancing point. It may not be exactly a full figure. It may be 3 point something or 2 point something. That can happen depending on the maturity date, maturity period, and the cash flows of the bond. But you can see this balances the cash flows in terms of present values. All these are cash flows, coupon payments. At the end, you get a face value plus coupon. So there's a big weight on this. If you put this on a flat surface and if you want to try to balance, what is the point that you need to put this? That is the place, the duration. So that is one way of looking at this Macaulay duration. Again, by looking at this, you won't get that much information. What is this? One more thing, remember the word duration, don't get confused with the maturity. When it comes to bonds, these are, or not only bonds, when it comes to financial markets, technically maturity and duration has two different meanings technically. Maturity, so this, for example, this bond, the maturity may be 5 years. That's why there are 1, 2, 3, 4, 5. Maturity is 5 years. That is the lifetime of a full lifetime of this bond. But the duration is almost 3 years. That is the balancing point of the cash flows. So don't get confused. Duration is not same as the maturity, but with one exception. For a zero coupon bond, the maturity and the duration would be the same. We'll discuss why and what is a zero coupon bond in few minutes. So once we discuss about duration, then we'll discuss about zero coupon bonds as well. So then this is the modified.
One question. Normally, when it comes to maturity and duration, most of times duration is less than the maturity.
Yes, yes, very important. Yes, if it is not, it cannot go beyond maturity.
Okay.
It cannot go beyond maturity. It should be at equal or less than maturity. Yes, duration equals to maturity only if the bond is a zero coupon bond. That means there's no, in a zero coupon bond, there's no cash flows, no interest like a treasury bill. Only you get the face value on the maturity date. That's a zero coupon bond. We'll discuss that. Only in that instance, you get duration and maturity as the same figure. Otherwise, duration is always less than maturity. Modified duration, this is a small change, adjustment to the Macaulay duration. This MACD is the Macaulay duration. We divide that Macaulay duration by 1 plus yield. Again, this K is the coupon frequency. We have to do that adjustment everywhere. Even in the previous equation, you might notice that the K is there. In this presentation, K is used to represent the frequency of the coupon flows. So this is the definition of modified duration. Macaulay duration divided by 1 plus Y. It is adjusted for the current yield. Then this figure is very easy to interpret and has a very practical meaning. The interpretation is given here. It gives the approximate percentage change in price for a 100 basis point change in yield. So what is 100 basis point? 100 basis point equals to 1%. Remember, what is the definition of a basis point? Basis point is a 0.01%. 1 basis point is 0.01%. If we make it a decimal, it is 0.0001. This is equal 1 basis point in decimal. But as a percentage, it's 0.01. So therefore, 100 basis points means 1%. If yield change by 1%, what would be the percentage change in the price? Not the change, but percentage. Can you remember? We calculate the duration as a percentage of the current price. That's why we divide. This 1 over P term is there. So it is relative to the current price. That is the interpretation. If the yield changes by 1%, what would be the change in the approximate percentage change in the price? I think you can now see the board. This is the price yield relationship. Price is on the y-axis, yield is on the x-axis. Assume this is the current yield for for that current yield, there's a price. We denote it as E0 and Y0. The duration gives the slope of this curve at this point, modified duration. Modified duration gives the slope of the curve at this point. That's why it says approximation. It may not give the exact percentage change. The reason is the relationship between price and yield is a curve. If we measure the duration and it gives a measure the slope, it is a straight line. So if you change the yield by some amount, the duration will give you a different price level than the current or what is the price should be. But this difference will be very small. That's why we said the duration will give you a approximation percentage price change. What is the change in price? This is the change in price. So modified duration gives you the change in price relative to price. Modified duration as a percentage. Change in price divided by price. So that's how we interpret the modified duration, and this has a practical meaning. If you know if the yield changed by 50 basis points, that means 0.5%, you can calculate what, if you know the duration, what would be the change in the price. You can calculate first as a percentage change, then multiplied by the current price, you get the new price. It is possible. So before we move into effective duration, I'll show you in Excel how do you calculate the duration. Okay, consider a bond with a face value of 100, coupon 8%, an annual coupon, maturity with 5 years. And the current yield is 7%. In Excel, last week we discussed how to do the pricing. So first we need the time periods. Since it's annual, we have 1 year, 2 year, 3 year, 4 year, 5 year, like timing up to 1 to 5, from 1 to 5. Then the cash flow would be, if the face value is 100, every year you will get 8 rupees. If the coupon is 8% and the face value is 100 rupees, you get 8 rupees cash flow every year. And on the 5th year, on the maturity date, you get 8 rupee plus 100 rupees coupon plus the face value. Then we can calculate the present value. You can see it is the D8, this cash flow divided by 1 plus market yield to the power time. You go to the second, you can see C9 is now 2. So if you calculate all present values of each and every cash flow and add them together, you will get the price 104.10. So this is the price we discussed last week, how to calculate this. Then to calculate the duration, what do we need? If we go back to the equation, it is time multiplied by the present value of cash flow and add those terms together. So therefore, here we calculate multiplication of this time by the weight. This is the weight. Present value of the cash flow is the weight. We multiply these two together for each and every time. Then we'll add them together. We get this figure. The Macaulay duration is then this total divided by the current price. So you get Macaulay duration of 4.32. If you want to calculate the modified duration, what you have to do, divide it by 1 plus yield. Macaulay duration divided by 1 plus yield. Then you get the modified duration. So this is the way how we can use Excel to calculate modified duration using the basic formula for the modified duration or the duration. Is it clear? I think with this example you might have get better idea how to calculate duration and modified duration. This is same thing but at different yields. The bond is priced, you get different prices. If the yield is 6.01, price is 108.38. If the yield is 5.99, price is 108.47. But one thing to remember, in this example, we use annual coupon. But if we use semi-annual coupons, the picture would be somewhat different. Consider this example, face value 100, coupon 12%, semi-annual payment, maturity 4 years. So then in market yield is 10%. In this instance, the coupon frequency is semi-annual. That means two coupon payments per year. Then how many cash flows do we expect? We expect 8 cash flows. Every 6 months you get a coupon payment. So therefore, there are 8 periods, 8 semi-annual periods. Remember, it's not 8 years. 8 semi-annual periods. Then cash flows are 6 rupees per each coupon period. For each coupon period, 6 rupees, except the last one. Last one, coupon plus the maturity proceeds. That is face value 100. So therefore, at the end of 8 period, you get 106 rupees. Now what we do, we calculate the present value of each cash flow as usual as we did in the previous example. So these are the present values. Then the price comes as 106.46. To calculate the duration, again, we multiplied this time in by this present value of the cash flow. Multiplication of these two figures. Same thing. Then at the end, we add all these figures together. We get this 706.07. Now, what would happen to calculate the duration? What did we do in the earlier example? The sum of these present values multiplied by the time in, we divide that figure by the price. Now you can see Macaulay duration came as 6.63. But as I answered to the question earlier, duration cannot be more than maturity period. Maturity is 4 years. Now you get Macaulay duration as 6.63. What is the reason? The reason behind is, in this, we get the duration in terms of number of periods. Here, number of periods are semi-annual periods. So the Macaulay duration comes as 6.63 semi-annual periods. It's not in years. If you want to make it in years, we have to divide this by 2 because this is semi-annual. If it is monthly, we have to divide it by 12. Now you can see duration, Macaulay duration comes as 3.32, which is less than 4. Then the modified duration, again, Macaulay duration divided by 1 plus yield divided by the frequency. Again, this 2 here because of semi-annual coupon frequency. 2 coupons per year. So the duration of this bond, when the yield is 10%, is 3.15. Is it clear? How to calculate?
Previous one, initial example,
Sorry,
above one, where we use seven. Can I see the previous example, sir?
Yes.
Initial example.
This one.
Yes. Okay. Yeah, there we take the interest rate is market yield is 7.
Market yield is 7. Yes.
Okay. So
coupon is 8. Market yield is 7. So basically the price is more than face value because you can see the coupon and yield relationship. Coupon is higher than market yield, then you should get a price above the face value. That relationship is correct. So when you do this sort of exercise, the first thing, whether you have done this or put this equation correctly, so the easiest way to check whether it's correct, what do? Put the market yield same as the coupon. Then what you should get price as 100. If you don't get something wrong in your calculation equations. So even that's why I don't know whether you have noticed that I put 12% here and again change back to 10%. I just check whether these this is correct. That can happen in Excel. If you mistakenly type something else, it will remain there in the cell. So output may be wrong. You may not realize that. So better you check this. Coupon and yield, put the same figure, then see whether you get price as 100. If not, something wrong. There's something wrong. First, find out that and correct the equation. Then you can put. So what I have put there, 7%. Yes. Is it clear now? Or you have
one question. So then Nestle duration calculated by 457 is the total, and that part I could.
450 is the total of this weighted average timing.
Okay.
And the sum of those divided by this 104. This is the price.
Okay.
If you go to the equation, it says 1/p into that sum.
Okay.
So this is the sum. 1/p divided by price.
Right.
You can see.
Then sir, when it comes to modified duration,
it's the Macaulay duration divided by 1 plus yield. 1 plus E6 is yield.
Yield in the sense that 7%.
7%. Not the coupon. Just remember, coupon and yield is two different things. Coupon is the interest rate that the issuer agrees to pay.
Yes.
Yield is the required rate of return for the investor.
Okay. That is the difference.
That is the difference. Even the issuer has agreed to pay 8% annually. With the current interest rates in the market, the investors are happy to take only 7% return. Yeah. So if you assume a bond which is issued in 2019, coupon rate may be 8% or 9% or maybe 10%. But if that's the same bond, if you want to buy it today, you don't expect that 9% or 10% return, because now the interest rates has come down. You may be happy with 7% or 6% interest yield return. So the market yield has gone down. Yes.
Okay. One more thing. Sorry for disturbing. This last one. How we check this? The amount is correct. That part will you able to explain again? That amount you can double the amount what we arrived is can double check here. You mentioned in the previous.
Because when the coupon rate and yield is same.
Okay.
Coupon rate equals to the market yield. The price should be par. That means the face value. When you put this 8% here, same as coupon rate, you should get price as 100.
Okay.
So other thing is, depending on this relationship also, you can check whether there's any mistake. If the yield is lower than the coupon rate, you know the price is higher than the face value. If the coupon rate is less than market yield, price is less than face value.
Okay. Right. Then this modified duration we use when investing in yield also. We can use this. Investing in bonds. Once we invested in bonds, we can use the modified duration. Is it? Or there is any other? Say, if we prior to invest buy a particular bond, are we going to check the modified duration? No. What is the purpose of having modified duration? Like
what is the interpretation of this modified duration? This is the interest rate sensitivity. So how do we interpret this? If the interest rate goes
by
1%, up by 1%,
yes,
price of your bond will be changed or decreased by, indeed decrease, because if the yield increase, price decrease. So
yes,
price will decrease by 4%.
okay,
Clear?
yes,
Price
yes,
would decrease by 4%. So what would be the new price? This is only an approximation. 104.1 is
okay,
the current price. If it decreased
okay,
by 4%, it would be only 0.96. So we expect if interest rate increase by 1%, price to decrease by 4%. That is the interpretation of modified duration.
okay,
So basically, so that's why you don't want this anything. The price is 104 now.
yes,
Modified duration 4. So the price would go down by 4% something. So that's why when we increase to this, I keep this as well. So we expect the price to be 99.93 if the yield increased by 1%. The same thing when I copied here came like this. Okay, you know what is this figure? That is the current price multiplied by 0.96. That means 4% less 99.94. But this is an approximation. That means we expect if interest rate goes up by 1%, the price will drop to 99.94. What would happen when we put it 8? The price is 100, close to 99.94. Okay, that's why we said this is only an approximation. It won't give you the exact figure. Why? I hope you can see the board.
yes,
Yes. Assume this is the point when the yield is 7%. Price is 104.4. Now what we did, we calculate the duration. When we calculate the duration, it gives the slope of the curve at this point. But that slope change continuously. But what do? We use that slope to estimate the price once the yield changes. So what does it mean? We assume a straight line. We think if the yield increase or decrease, price would move along this line, not along this curve. So 7% to 8%, we estimate the price here, 99.6 or 993 or whatever the price that we get once we use the modified duration. But that at the 8%, exact price is 100. Clear? Since we are using that approximation, we get a much lower price than the actual price when we go to the right. That means when we increase the yield. But the reverse is true when we go other way around. From 7% to 6%, again, actual price is higher than, this is actual price, and this is estimated price. Estimated price using the duration at this point. Is it clear? So
clear. Yes.
Both time we get the lower price than the actual price when we use this modified duration to estimate the new price for a given change in yield. Yes.
Sir, now one more thing. Can you one more time explain the how we can arrive to new price using modified duration?
New price. Yes.
Yes.
So if you can tell me, when the yield is 7%,
okay,
price is 104.4. Just assume.
Yes.
Okay, what is modified duration is 4.4 something.
Yes.
Correct?
Yes.
So what is modified duration? That is the percentage change of the price for a given for a 1% change in yield.
Yes.
Okay. If yield increases to 8%, that means if yield increase by 1%,
yes,
yield increase by 1%, what is the percentage change in price? It is 4.4%, same as the modified duration. If the yield increase by 1%, we expect price to change by 4.4%. But we know if yield increase, price decrease. Then we'll calculate if you know the percentage change, what is the change in price? Current price is 104.4. We expect it to be changed by 4.4%. So current price into 4.4%. This is just the change in price. This is the percentage change. This is the percentage change given as modified duration. This is the current price. So when you multiply by these two, you get the change in price. So then what is new price? New price is current price minus change in price. Correct? This is the change in price. We expect the price to be changed by this amount, but goes down since yield increases. So price minus change in price. What is current price? 104.4 minus 104.4 into 4.4 divided by 100. So 1 minus 4.4 divided by 100. 1 minus thing is almost 0.9956. Is it correct? One minus 0.044. You get 0.956. This is what I use as 0.96. the price multiplied by 1 minus modified duration as a decimal. Is it clear?
Yes.
This is very simple thing. If you are given a percentage change, what is the new price or new value? Simple percentage calculation. Clear?
Yes. Yes, sir.
Okay. Now, I will discuss about the price again. Last week when we discussed about pricing, I mentioned the example we got, like face value of the bond is 5 million or something. The big we considered big amounts, 5 million, 5 billion or 10 billion. You can use that as well, but to make it easy, what do we do? Always we consider face value as 100. Then everything is in terms of percentage compared to 100. Now today example, you saw I use face value is 100. But reality, in practical, in Sri Lankan context, one bond. So you can, like, if you say 1 kilogram, this is the unit. If the price is 120, this is the price of 1 kilo, 1 unit. Likewise, even though we said they issue 5 million worth of bonds, that is face value is 5 million, but the number of bonds are not 5 million. Generally, one bond, face value of one bond is rupees 1,000, especially in Sri Lankan government bonds, US treasuries, and in many countries, government bonds. Face value of one bond is 1,000 rupees. So, if you want to buy bonds worth of 5 million, then the number of bonds that you have to buy $5 million divided by 1,000. That means 5,000 bonds. But if you take a CDS report or wherever, usually we don't prefer this figure. We always refer to this face value. Even in the market, if you want to do a trade, you will tell, I want to buy 5 million of this security. Then it doesn't say that you want to buy 5 million bonds, but the face value of those bonds. That is one thing that you have to remember. The other thing is this pricing. Price of a bond would be, say, maybe expressed as price is 99.89. Then what does it mean? In the market, you see price as like this. Maybe there may be few more decimal points. This is the price. What does it mean? This is the price of a bond if the face value is 100. But as I told you, face value of a bond, one bond is 1000. Then the real price of this is 998.926. If you want to buy bonds worth of 5 million, the price that you have to pay would be 5 million. This is the face value you required, 99.8926. This is the percentage. This is the amount that you have to pay. So it's same as 5,000 into this 998.926. Number of bonds into price of a bond. So remember that as well. But in the market, we go by this face value and the percentage price. This price is a percentage. We do calculation based on the face value 100. So the price comes as a percentage. If the face value is 100, price is 99.8. This is the percentage price. So based on the face value, we can calculate the total price that you have to pay or that you would receive. Clear? Number of units and the amount in terms of rupees. There's a difference, and the price is expressed as a percentage. Then the other thing, zero coupon bonds. What is a zero coupon bond? There is no coupon payment, no cash flows until maturity date. So therefore, in simple, coupon rate is 0. There's no coupon rate, no interest payment at any frequency, not even annual or semi-annual, nothing. Only at the maturity you get the promised face value, like a treasury bill. You know, treasury bill, there's no interest income until you reach the maturity. Whatever the price you paid and the face value that you get, the difference is your interest income. Even in this also same concept, but it's a bond. That means maturity is more than 1 year without any coupon payment. So the coupon rate is 0. So therefore, in a zero coupon bond, you have only one cash flow at the maturity date. No cash flows before the maturity date. So again, then what is the price? It is easy. You have only one cash flow, that is the face value. To discount it, by this factor 1 plus r to the power n. N is the number of years, r is the your required rate of return. So definitely in this price is less than face value because this is a discounted product. There are no interim cash flows. You get only the face value at the maturity date. So therefore you want to buy it at a lower price than the amount that you get. Clear? So this is the zero coupon bond. This is the price. So if you calculate the duration, is say Macaulay duration 1 over P and timing into the present value of the cash flow. At the end of n years, so therefore n, you get the cash flow FV, the present value is this. What is this part again? It is same as the price. So basically n into P over P. So P will cancel n. So therefore, Macaulay duration of a zero coupon bond would be equals to maturity. This is because of you don't have any interim cash flows. If you go by that definition, that's the time that would take to pay back your investment. In a coupon bond, it may be before maturity. But in a zero coupon bond, as you don't get any cash flows before maturity, you have to wait until maturity to get your cash flow back. So this is a very important thing. For a zero coupon bond, duration equals to the maturity of the bond. Any question?
Now, sir, we arrived at the bond price now. That previous example, same figure we can arrive using the pricing formula as well in Excel sheet.
You won't receive the same figure. So
yes,
here,
can we get
in
using
this
the
example,
Excel formula?
yes, when the yield is 7%, price is
Okay.
104.10, duration is 4.04. Okay.
Yes.
So
Okay.
so this if we expect yield to increase to 8%, and if we use this modified duration to calculate the new price, it would give you 99.94, because how we get it, current price times 1 minus this duration. So make it easy. I put 1 minus duration divided by 100 to make it decimal. Now is it clear?
Yes.
So you get 99.89. I'll
89. Yes.
Yes. I'll copy this here. Otherwise, whenever I change the yield, this figure also changes. So this is the estimated price. Shall I put it here? This is the estimated new price, 99.89. But if you use the equation to calculate the price, when the yield is 8%, you get 100, not 99.89.
Yes, yes.
So there's a difference. This is because if you use modified duration, you get only an approximate change.
Okay, okay. Right.
If you go back to this, now can you see the presentation? No.
Yes.
You can see the presentation.
No. No. Now still we can see the Excel sheet.
Excel sheet. No? So we have this type of curve.
Yes.
This is 7%.
Okay.
This is at the 7%. This is the price.
Right.
E naught. When we calculate the duration, it gives the slope of this curve at this point. Then we assume the slope is constant everywhere. That means we assume price changes along a straight line.
Okay.
When we increase this 7% to 8%, according to the modified duration, price will be somewhere here. But the real price is here. This is the estimate. This is the correct price. If you go this way, that means decrease in yield, still price would be lower than, estimated price would be lower than the real price. There's a difference. Clear?
Yes, yes.
Because we assume we move along a straight line instead of this curve. The next measure that we are going to discuss, convexity, gives us an adjustment for this difference. Again, still it won't make it 100% correct, but give some adjustment and price will get closer to this real figure. Clear?
Yes, sir. Yes.
Okay. Any other question? So if not, we'll move into.
Yes. Then, sir, if we want to buy a particular share, then by looking at the estimated price, we can decide whether this price is worthwhile to buy this particular bond. That decision we can come. No.
You don't look at the estimated price, because if you want, you can exactly calculate what would be, if the yield changes, what would be the price. But what do you look at? You may look at the duration. So there may be same yield, almost same yield, same maturity, but the duration figures may vary.
Right. Yeah.
Then if you buy a one bond with the high duration and interest rate increases, what would happen? Price decrease would be more than the other bond.
Okay. For the comparison, we can use this.
Yes, if you use two modified durations,
okay,
MD1 and MD2, if modified duration 1 is higher than modified duration 2, what do you expect? If yield increases, price decrease by a higher amount of this bond. but the other bond also price decrease but by a small percentage. So therefore, if you think interest rate to increase, you buy bonds with less modified duration. But if you think yield to decrease, then you know price to increase, then you would buy bonds with high modified duration. Is it clear?
Okay.
Because when the yield increase, price decrease. So you want less price decrease, not the high price decrease. But if yield decrease, price increases. You like to get more price gains. So therefore you may buy
higher rate,
higher modified bonds with a higher modified duration. So that's how you compare two different bonds with almost same maturity, same yield. But then you compare duration. One thing, then now you should be able to understand coupon, yield, maturity, and duration. I'll put it as modified duration. What is the relationship? If the coupon is high and the yield and maturity remain same, what is the impact on the modified duration? If the coupon is high, you get high cash flows. Therefore, the payback period would be short. Modified duration is low. If the coupon and yield is same, but the maturity is long, what do you expect in the modified duration? Coupon and yield same. Consider two bonds. You have the same coupon, same yield, but two different maturities, 6 years and 8 years. In which bond do you expect high modified duration? It is the bond with long maturity.
Long maturity.
And assume if the coupon and maturity is same, but you have two different yields, which one would have high duration? Go back to this curve. If the yield is low, slope is very high. So in this area, modified duration is high compared to this area. Even for the same 1% yield change, price would change only by a small margin. But in this area, for the same amount of price change, say this much yield change, price change is high. When the yield is low, modified duration is high. When the yield is high, modified duration is low. So best thing is go back to a worksheet like this. Do some calculations with different figures. Say, fix the coupon, change the maturity, and calculate the modified duration. You can see what is the change. Then fix the maturity, fix the yield, change the coupon rate. See what would happen. So even here we can do, if you can remember, now the modified duration is 4.3 when the yield is 8%. What would happen if the yield is 7%? Yield decrease. So you should get higher modified duration. Earlier modified duration was 3.99 when the yield is 8%. When the yield is 7%, modified duration is 4.05. Now you can see when the yield decreases, modified duration increases. So coupon 8%, yield 8%, duration 3.99. What would happen if I increase coupon to 10%? Modified duration should be less than 3.89 for the same maturity, same yield, but the higher coupon. If we increase 12%, 3.8, modified duration goes down when the coupon increases. For the maturity, I can't do it here because we have to replicate different cash flows. Okay, but still here, 8%, 5. Coupon 8, yield 8, maturity 4 years, 3.37. Coupon 8, maturity 8, coupon 8, market yield 8, maturity 5 years, 3.99. 3.99 versus 3.51. You can see when the maturity is maturity is low, modified duration also low, frequently. Even with semi-annual coupon, even we make it annual coupon, there may be a slight change, but still you should be able to see when the maturity reduces, duration reduces. So the relationship between coupon, maturity, yield, and modified duration. So you should be able to recognize that relationship and to interpret modified duration and do calculations based on the modified duration. Any question?
No.
So shall we move into the next? This effective duration is a way, I would say for you it's enough to know this is a shortcut to calculate the duration. What do we do? This is the yield price relationship. Can you see the board?
Can.
So what do we do? At two different yield levels, this is the current yield, Y naught. We calculate the price, P naught. We change the yield up to Y1 with a small change in yield, then estimate or then calculate real price, actual price, what is P1. We increase the yield by some amount, calculate the price. Same thing we do, but same amount, same yield change, but we decrease the yield, then get the new price. Now we assume this part is a straight line. This part is a straight line. Then what is the slope of that curve? How do we find the slope? If you can remember your grade 7, 8 mathematics, P2 minus P1, the difference between these two and difference between these yield. It should be now Y1 minus Y2, and we express this as a percentage of the original price. That's how we calculate the duration. Yes, this is, if you want to do the exact way, it should be Y2 minus Y1. Then you can see Y2 minus Y1 is a negative figure. The duration or the slope comes as a negative figure. That is correct. Even in the previous equation, though I have not put minus figure, duration is a negative one. What is reflected through this negative is that inverse relationship between yield and price. When yield increase, price decrease. When price or the yield decrease, price increase. This negative sign reflect that, but when we express the duration, we just ignore the sign. We say duration is 4.4, something like that. But reality, duration is minus 4.4. If the yield increases, price decreases. Percentage change is negative.
Here, sir, the one over P means the price.
This is the current price. We divide by the current price to make it as a percentage of the current. That's why we use this. It's not exactly slope. Now it becomes duration. This is indeed the effective duration, which I have put in the slide in different notifications. But this is the concept there. You can see BV, bond value, when the yield change decrease, minus delta Y means yield decrease. When the yield decrease, price is high. This part is bond value when the yield increase by the same amount. Delta Y is the change in yield, same amount. So this is the lower price. When yield increases, price goes down. This is the new value of the bond once yield increase by same amount. Divide by this BV naught is the initial price, and this 2 into delta Y comes. This is the difference. 2 into delta Y is the difference. You can see this change is delta Y, this change is delta Y. The difference between Y2 and Y1 is 2 times delta Y. That is the part given in that equation. The total yield change, this distance, because we divide price or the distance between two prices by the distance between two yields. This part is given as 2 delta Y, and this P. This is bond yield when the yield decrease. This is bond value when yield increases. Instead of P2, P1, I have used different notifications. That's it. But this is the first term is the price when the yield increases. Second term is the price when the yield increases. Divide by the current price and the total yield difference. Total yield difference. So I'll show you in Excel. Can you see the Excel sheet?
can't.
Yes. Okay, this one. This is a 2-year bond. Two-year bond, face value 100, coupon 7%, semi-annual coupon, then frequent should be 2. When the yield is, coupon is 7%, we know if the yield is 7%, price is 100. Correct? If the yield is 7%, price is 100. So what I have done, from 7%, change the yield by 0.25%. That means 25 basis points. From we add 0.25% to the 7%, then we get yield 7.25, like 7 plus 0.25 and 6 minus 0.25. These are the yields that I have considered. 6.7, sorry. 7 plus 7 plus 0.25 is 7.25. 7 minus 0.25, 6.75. These are the prices when the yield is 6.75 and the yield is 7.2. What I have done here, J57. What is that? Price when the yield decreases to 6.75. M57 is the price when yield increases. Take the difference, then divide by 2, divide by 0.0025. Remember, in these equations, yields, change in yields, you have to put it as decimals, not as percentages. So the change in yield here is 0.25. Change in is 0.25%. So when you put it into the equation, you have to put it as 0.0025. That's why I have used it here. Clear? So then you get effective duration. ED means effective duration as 1.83. Now you can see if you calculate the Macaulay duration, that is this 381 by divided by 100, you get 1.90. And you calculate the modified duration, again you get a very close number. Because when the yield change is very low, very small, the changes are very small, then that part we can consider as a straight line. But when the changes are high, then you can't consider that price yield relationship as linear. So therefore this modified duration works when the changes in yields are very low. For small changes, this modified duration or the duration concept works well to estimate the new price. Usually we don't use to calculate if the yield changes by 2%, 3%, what would be the change in price. Only we don't use only modified duration. But with the combination of convexity, we can get much better results. Clear? How to calculate effective duration. Sometimes this is, if you know the prices, this is easy to calculate effective duration. And there are some bonds, especially callable bonds, the price and yield relationship won't remain as what we discuss. Price yield relationship won't be same as this for a callable bond. So for those bonds, we don't just calculate the duration. Instead, we calculate this effective duration. So we'll move forward. Modified duration, we discussed. Modified duration gives you a relative value, percentage change. All previous example we discussed modified duration, it is as a percentage change. Then you have to calculate what would be the rupee value or dollar value. For that, to measure it easily or quickly get some idea, this dollar value of a basis point concept is used. What would be the change in price or the value in terms of dollars or rupees, whatever unit of currency, if the yield changes by 1 basis point? If the yield changes by 1 basis point, what is the change in price? This gives what is the change in price, but in the modified duration, it gave you the percentage change, not the change, percentage change. But here you get the change in price. So for a 1 basis point change, what is the price change? But modified duration gives you percentage change for 100 basis point of yield change. Remember that as well. Here we talk about for a 1 basis point change. In the modified duration, it's for 100 basis point change in yield and percentage change in price. Here, change in price, but for a 1 basis point. So if we know the duration, that is the percentage change in price for 100 basis point. Then if we multiply it by this 0.001, that means 1 basis point, both these terms together, you get percentage change for a 1 basis point. These terms together, you get percentage change for a change in 1 basis point. Then you multiply that by the bond value, you get the change in price for a change in yield of 1 basis point. So this is the definition of DVO1. This is just a small extension of the duration. If you know what is the duration, you can calculate DVO1. If you know the definition of modified duration and how to interpret, what is the meaning of that, then this is easy. So then we'll move into the next topic, convexity. As I mentioned, the slope of this line that gives you the duration at this point. And we assume when we use only modified duration to estimate the new price, we assume price would change along this straight line, not along with this blue curved line. So therefore, from 6% to 8%, if the yield change to 8%, and we estimate using the duration, price would be somewhere here, but the real price is a bit higher than that. So there's a small difference here. That difference depends on the curvature of this curve. There may be another curve going through the same point, but it may be like this. The curvature is higher than this blue line. There may be another one, something like this, more curve. So this curvature, the measure of this curvature in mathematical terms, we call it convex. This when the curvature in this way, this is called convex. If the there may be curves like this, we call this curve as concave curves. These curves we call as convexity. So the curvature is measured through this convexity. It is again a mathematical concept. We can use that concept to make the adjustment. What would be the difference here? So we'll add that part to the estimated price we got through duration. So first we'll discuss what is convexity, what is the definition. So it measures the curvature in the relationship between bond yield and price. Indeed, it is the rate of change in duration. So what is the duration here? What is the duration here? This slope is higher than this slope. So the slope changes along this curve. Convexity measured at what rate? The duration changes. In mathematical term, slope is the first derivative of this curve. That price yield relationship, that means our pricing equation. The convexity is the second derivative. Those who have some mathematical knowledge, you can think it as derivatives. Others, don't worry about it. Just get the intuition behind it and the equation. So the convexity measured or the calculated through this equation. Again, what is this? Same as what we used in the effective duration. What is the price of the bond when the yields decrease by a certain amount? The second term, what is the price of the bond when the yield increase by a certain amount, but same as the previous amount. When we calculate the duration, it was a negative sign here, but here in the convexity we add them together and subtract 2 times what was the original price of the bond and twice of it. We subtract this part. DV naught is the price, current price. BV plus delta y is what would be the price when the yield increases. BV minus delta y is what would be the price when the yield decreases. We add those new prices together and subtract the amount which is equal to twice the current price divided by current price and the square of the change in yield. Again, remember this change in yield you have to input as a decimal place to this equation, not as a percentage. Remember that for all these equations, even here, that's why this is as a decimal. This is 1 basis point as a decimal. Here also you have to include as a decimal. So this is how we calculate convexity.
So here the BV plus delta y means price when yield increase.
Increase. Plus delta y means yield increase. Minus delta y means when yield decrease. Same as here. Effective.
Thanks.
So these definitions valid even for the convexity equation. See, delta V minus delta y price if yield decrease by a given amount. The delta y is the given amount. The same amount plus and minus. We change the yield by the same amount. Can you remember in the previous example, I use 0.25% plus 0.25% minus 0.25%. The change in yield is 0.25%. Plus and minus, or add and subtract the same yield to the current yield. Clear? Is it clear?
Yes, sir. Yes, yes.
Okay. So basically these two prices same as these two. Only small change, put plus minus 2 times BV naught, drop these two, bring it to here, cut it here, bring it to here, make it plus minus 2 BV naught. This is convexity. Clear? Effective duration equation and convexity equation. So very close. Same terms are used. Okay, convexity. What does it reflect? If the higher convexity, if the convexity is high, what does it mean? Greater the price volatility. In this, I said the convexity of this graph is higher than this blue graph. If I put 1, 2, 3, convexity of curve 1 is less than the convexity of 2, and which is less than convexity of 3. So where do you see high price volatility? You see price volatility is high in this third one compared to second one. The second one, price volatility of curve 2 is higher than price volatility of curve 1. So when the convexity is high, price volatility is high. And then again, relationship between coupon and convexity. When the coupons are low, convexity is high. When the coupons are low, what about duration? Low coupon, then duration. Is it high or low? Duration? High. Yes, correct. When the coupon is low, that means you get very small cash flows. To recover your investment, you need longer period. So the duration is high. You can think in that way, or you can go back to the equation and see the relationship. When the coupons are high, convexity is low, and in this instance, duration also low. Because when you have high coupon, you recover it very quickly. So therefore, the interest rate sensitivity is very low. Okay, now tell me, out of 1, 2, 3, which bond would have high coupon? Coupon 1, coupon 2, coupon 3. If I ask you to order these 3 coupons in ascending order, how do you write? C1, C2, C3. What is the lowest coupon out of these 3? convexity, which curve the convexity is high? I mentioned that. So think about it and try to arrange this in the ascending order. So you can do that again. Go to the Excel sheet, do calculation and plot the graphs. See what is the outcome.
Can you see one moment? One moment, can I see that to draw?
This one?
Yeah. 1, 2, 3.
First curve, second curve, third curve.
That comes from the same this thing, no? Like same A and B. That was okay.
No, this point is same. This point is same. That goes to the same point. Otherwise, it would be difficult to compare. You can draw it at different levels.
Okay.
Okay. So then, how do we use this duration and convexity to estimate the percentage price changes? So earlier we used only the duration to calculate the change in price. Now here we are going to include the convexity effect as well. In this equation, we have included the minus sign of the duration. Otherwise, you have to think and do the adjustment. But you have to do this duration effect separately. If you don't use this minus sign here, you have to do duration effect separately and then do the adjustment for the convexity. But it is easy to do it at once without doing separate adjustments. So therefore, we have included the minus sign. So this is what we discussed earlier. Duration into 100 times for a given change in yield for 100 basis to make it decimal. So this is the equation. We'll do get some intuition behind this equation or how to do the calculation with this example. Consider a 15-year 7% option free bond. Again, what does it mean? It's not a callable or a puttable bond. No call option, no put option, nothing. It's a plain vanilla bond that you get coupon every year, and at the maturity after 15 years you get the face value. Investor cannot ask money early, or the borrower cannot repay it early. No such option is available in this bond. You have to hold it until maturity, both parties. Now we are asked to estimate the effect of a 150 basis point increase and decrease on the bond price. What does it mean? If the yield increase by 150 basis points, what would be the effect on the bond price? And if the yield decrease by 150 basis points, what would be the decrease on the bond price? This information is given, duration and the convexity. We don't want to calculate duration and convexity. It is given. So therefore, we don't have to worry about whether this is a semi-annual coupon bond or an annual coupon bond. Otherwise, we have to worry about it. If we have to calculate duration, we need to know whether it's a annual coupon or semi-annual coupon bond. And what is, just go through this and let me know what is the market yield now for this bond. What is the market yield? What is the coupon rate?
Excuse me, we can't see the presentation.
You can't see the presentation. Now,
Yes, we can see.
so go through this given information. Let me know what is the coupon, what is the market yield. The duration and convexity is given. So therefore, we don't want to worry about whether it's a semi-annual coupon or an annual coupon. What is the coupon? What is market yield? Maturity is 15 years given. Consider 15 years. That means maturity. What is this 7%? That 7% is the coupon. Then what is market yield? Is it given? It's not explicitly given, but it's implicitly given. Why? What does it mean? Trading at par. What's the meaning of that? We discussed last week trading at a discount, trading at a premium, and trading at par. What does it mean, trading at par?
Similar to face value under.
When we say it's trading at par, what does it mean?
Similar to face value.
Sorry?
Similar to face value.
When we say it's trading at par, if the price is less than face value, then we say trading at a discount. Trading at par means
Similar to face value.
Similar to say face value, yes, at the face value. For that to happen, what would be the market yield? If the price equals to the face value, what is the market yield?
7%.
7%, the same as coupon percent, coupon payment. So the market yield is also 7%. So now, when you see this sort of question, don't think question is incomplete, that necessary information is not given. Just go through the question properly, find out these sort of things, tricks. Okay, the informations are here. Then what do you have to do? Use this equation. Duration is given 9.115. So when the yield decrease, so we have to do calculation for two scenarios. One is when yield decreases, the other one is when yield increases. What is the percentage change in price? When the yield decrease, duration is still 9.115. But remember the change in yield. The second term is the change in delta y. Delta y, that's the change in yield. Remember, when yield decreases, change in yield means new yield minus previous yield. Then it is a negative figure. So we have to put this negative sign here. 150 basis points means 150 basis points equals 1.5%. In decimals, it is equals to 0.015. So you have to be careful when you substitute figures into the equation. So this will give you a duration effect. Now you can see when you do this calculation, you get a plus figure. Since yield decreases, price increases. You get that. What is the percentage change in price increase? Then plus the convexity effect, half. This is convexity figure as it is. Then the change in yield to the power 2. In this, whether you put this minus sign or not, it won't have any impact, because when you take the square of a minus figure, still you get a positive figure. So you can see there's a mistake. This should be plus. So you get 14.964% percentage change in the price. If yield decreases, price will increase by almost 15%. This will give you a much closer figure than the what you get through this. You can see in this convexity part, even you go to this part, the convexity correction part is always positive. There's no negative. Why? You can see whatever the estimate given by the duration, we have to make a upward revision wherever it is, no downward revision. So the always convexity effect is positive. So for the second part, always you should get a positive figure, but for the duration effect, you can get a negative figure when the yield increases. Here you get a, since yield increase, duration sign is negative, but the change in yield is positive. So you get a negative impact here, but this part again would be the same thing what you get here is a positive, that therefore, but this negative part is much higher than this positive part, you get a negative figure. It's obvious. Since yield increases, price should decrease. So that's why you get a negative answer. When yield increases, price decrease by 12.38%. The other thing is, you can see same amount change in yield, but two different effects. Why? Again, because of this convexity. When the yield decrease, price change is much higher than the yield increases. The slope is very low in this area, but the slope is very high in this area. So when the yield decreases, price increases at a higher rate, but when yield increases, price decreases at a lower rate. So therefore, you get small negative figure here than this positive figure. So this is the impact of convexity and how do you calculate the impact. Once you get this percentage change, you can estimate the new price using the same way that we used earlier. Then the last point, all these things we discuss for a particular bond, for a one bond, but the same concept, duration and convexity, can be applied for a portfolio. In that, what do? We calculate duration and convexity for each and every bond in the portfolio. What is a portfolio? It's a collection of bonds. So we have maybe 100 bonds, but we have invested in different amounts. So then we calculate the market value of each and every bond, get the total, then calculate this weight. The weight is for particular bond, what is the amount invested in this particular bond, and what is the total market value of the bond. Amount invested in a particular bond, market value, and the total market value of the portfolio, that is the weight. So for each and every bond, we calculate the weight and the duration, then calculate the weighted average. Weight multiplied by the duration, add them together. That is the duration of the portfolio. Convexity also same. We calculate the convexity for each and every bond, then multiplied by the weight, add them together, you get the convexity of the total portfolio. Then you have some indication about the sensitivity of your portfolio as a whole for a given interest rate change. So that's all about this duration and convexity. I think, yes, they have gone through the, we have used more time than expected. Okay, but still, if you have any questions, we'll take a few more minutes to answer those questions and then take a break. If you have any questions. If you don't have any questions, we'll take a break here, 10 minutes break. So almost 10:40, we'll start at 10:50. Is it okay?
Okay.
Okay, so if you have any questions, oh yes, you can ask after the break as well.
At the exams, like, are we getting equations or do we need to memorize?
You have to remember the equations. Anything else?
Yeah, is it possible to share the Excel sheet with whatever the formulas you use?
Yes, I'll ask him to. I can share, frankly, but thing is, if you just use that Excel as it is, it won't help you. Try to do it by yourself, then only you get to know about the equations, what is really behind that. But I will share. It's not a big matter. There's nothing.
So in previous sum that you want us to see the how are we going to order the coupon, is it?
Yes,
That,
yes, that's what I asked. That question, yes.
Then, okay, that we need to discuss between the relationship.
Shape of the curve, then you should know which one has the highest convexity. And you know the relationship between convexity and coupon. Based on that, if the convexity is high or the coupon is high, convexity is low. So you know
Low.
that based on that you can adjust it. No? You can think.
Yeah. That means if coupon is high, convexity low means the curve need to be
Basically, if convexity is 0 when the curve is linear.
Okay. Right.
Convexity measures the curvature. If there's no curvature, convexity is 0, because then you need not to have no need to do any adjustment for the convexity in that
Okay.
equation.
That means the low convexity mean it's like U, maybe similar to U type.
Low convexity means it's a zero convexity means it's a straight line.
Straight line. Okay.
If you don't have any question, I just explain you about a portfolio. So assume the portfolio consists of 5 bonds. So you can see the Excel sheet.
Can't see.
You can't see.
Now can see.
Now
Can see, sir.
you can see. Okay. Say there are 5 bonds in your portfolio. These are the market values of each and every bond. So in that sense, the total is, say, somewhere around 9 million. Then what do you have to do? Calculate the weight. The weight is just the market value of the bond divided by the total market value of the portfolio. If you want, you can make it as a percentage. So make sure you get 100 there. Yes, correct. Then to calculate the duration of the portfolio, what do you have to do? Duration multiplied by this weight. So duration multiplied by this weight. Then for each and every bond, you multiply the duration by these weights and take the sum. So the duration of the portfolio is 5.5. It should be somewhere in between the largest and the smallest. It can't go beyond that. So this is the duration of the portfolio. Then the convexity of to calculate the convexity of the portfolio, convexity multiplied by the weight, same thing, take the total. So convexity is this. Duration of the portfolio is 5.5. Convexity of the portfolio is 82.65. What does it mean? If interest rate increase by 1%, value of the portfolio will decrease by 5.5% if you want to do a convexity adjustments. you have to use this as well. Is it clear how to calculate duration and convexity of a portfolio? So
how we going to calculate the weight? Like, can you explain that?
So weight is the market value divided by the market value of a particular bond divided by the total of the total value of the portfolio. If you go to the second one, market value divided by the total. Clear?
Okay.
So this duration and convexity figures just arbitrary. All these are arbitrary figures. I just would say, not sure whether duration is 1.5. The convexity can happen like this. It may be there may be inconsistencies, but I just wanted to show you the way how do you calculate. So if you don't have any questions with regard to duration calculations, shall we move into the new topic, derivatives? Is that okay?
Mm-hmm. Okay, sir.
So now we discussed about foreign exchange and bonds, basic products in the financial markets. We didn't discuss about any equity. With related to equity, we are not going to discuss anything basically, but we may use some equity examples, derivatives. That the reason behind is that it is easy to understand the concept, because what you have to know about equity is just it's a security or a share of a company, and there's a price. So not like bonds or FX, then you need little bit more knowledge on the what we discuss. Definitely you need that. You should know what we discuss on foreign exchange side and bonds to discuss derivatives, but it is easy to learn that through some examples in equity. When we discuss derivatives, we may use some equity examples, but yes, I think still you can manage that without, because we are not going to discuss about how to price, find a price of equity or a share. We are not going to discuss that. We just take the price and discuss how does that how does it relate to derivatives. So that's it. Therefore we can use it, but as I mentioned, whatever the products that we discussed so far, you should have that basic knowledge, especially in FX and bonds, because we'll have to use those in derivatives. So I'll start with few comments made by some internationally accepted or persons, those who have international recognition. You might know about Warren Buffett. Who is this? So this is his view on the derivatives. He thinks it's as a weapon, financial weapons of mass destruction. So that's very negative. He thinks it can destroy the market. That's what he's thinking. Then James also is from US. So very known hedge fund manager, but he has some different views. Derivatives in and of themselves are not evil. There's nothing evil about how they are traded, how they are accounted for, and how they are financed, like any other financial instrument, if done properly. It's the very important thing. Yes, if you use it properly, there won't be any harm. It's like any other financial instrument as well, whatever we discuss. If you use so as an individual, you can borrow. So a loan, is it a good product? Yes, it's a good product if you use it properly, unless it would be a very harmful thing. You have the borrowing capacity, you borrow and you just consume it without putting that money into a productive thing. What would happen? You will end up in a debt trap. You borrow, then you consume it. There's no income stream in the future. You have not generated any cash flows through those borrowings. Then you will be in trouble. Same thing can happen here as well. If you don't use the derivative product properly, then it's not good. It will give you harmful or the bad results. That's what he's trying to say. The next one from Terry, she worked for JP Morgan. I don't know now whether she's at JP Morgan. So this tells us, I think, everything about derivatives, how we should treat it. So when a car crash, we don't blame the car. It's not the fault of the car. Very rarely it can happen due to mechanical reasons, but basically it's the driver. Same thing is true for the derivatives as well. It's not the product. That's how we use it. If you don't use it properly, derivative will give you a bad results. In Sri Lanka, we have experience. You might know the hedging transactions done by CPC. So we have bad experience. The thing is, we have to use correct product at correct time in the correct manner. So if you don't do that, there will be a bad results. Even a knife, it's a good tool, but you should know when to use a knife, when you should use a axe, things like that, and for what purpose that you use a knife. Same thing even for the derivatives. So don't have any bad idea about derivatives. Not only the use and the results, about the difficulty. Don't think it's very difficult. You need rocket science knowledge on the rocket sciences to understand derivatives. Not necessarily. Yes, after some, when you reach some level, you want to do more sophisticated things, you may need it, but at this level you don't want any rocket science, but have the basic idea about financial markets and products, especially products. Then, and you need common sense as well. Then you can understand derivatives, how to what is profit. That's what happened when it comes to discuss derivatives. You may forget about how to calculate profit as well. The simple concepts like that, what is profit, what is price, these simple concepts you should be clear about it, how to calculate profit and things like that. So don't be afraid to discuss derivatives. It's not that difficult, but you need the basic knowledge on the financial products. So I expect from you basic knowledge on the products that we discuss in this course. So now we'll move into the subject. What is a derivative. We discuss about whether it's good or bad. But what is a derivative? It's again a financial instrument. Derivative is a financial instrument. The return or the value of that instrument will depend on another financial product, or maybe a commodity, or maybe something else as well. But in financial markets, we consider it's only the financial products and commodities. So we call them as underlying assets. There can be derivative transactions based on weather as well. What is the rainfall? What is the temperature? What is the snowfall? What is the wind power? Things like that. But here we are not going to focus on those underlines, but we are going to focus on underlying assets. Those are either financial instruments or commodities. All these together we call as financial derivatives. Again, derivative instrument is a product, financial product, which gives you a return based on some other financial product. If you can remember, we discussed about FX forward transaction. FX forward transaction. So price of FX forward or the forward rate depends on the spot rate and the interest rates. Two interest rates, spot rate and the two interest rates. What are the two interest rates? The interest rate of the base currency and the interest rates of the counter currency. Depending on those two interest rate and the spot rate, we derive the forward price. So therefore, forward price is derived using some other financial products or the instruments, interest rates and the spot exchange rates. Therefore, forward, FX forward is a derivative product. It's a very simple derivative product. The return of the forward contract may depend on the, definitely will depend on the interest rate movement and the movement in the spot rates. So that's a very simple derivative product. If the FX forward is a derivative product, FX swap is also a derivative product, because FX forward is a combination of a spot and a forward, or a forward and a forward. And the other thing, financial derivatives. So from the basic products, like we are going to discuss, we can create derivatives. Then after that, as the second stage, we can create another derivative based on a derivative product itself, or as a combination of few derivative products, or a combination of a simple financial instrument and a derivative. That can happen. Derivative can be a combination of a derivative and another product or simple product as well. So the underlying assets may vary depending on the product. However, here we are going to basically discuss about these underlying stock. That means individual shares, bonds, currency, that means foreign exchange, commodity like gold, oil, and the interest rates, and index. What are the indexes? There can be bond index or share index, like in Sri Lanka, all share price index, or S&P 20 SL index. Those are the indexes. The derivative can be based on that indexes as well, or maybe based on individual shares, individual bonds, or maybe bond indexes. In Sri Lanka, we don't have a bond index, but in other countries they have bond indexes. So these are the basic underlying. But as I said, the underlying can be another derivative as well. So currency, bond, interest rates. These are things that we have already discussed. So you need some knowledge, or the knowledge, basic knowledge on these products based on what we discussed so far. Stock, you need not to have much knowledge, but the base, very basic, what is a stock and what is the price, that's enough. How to derive the price or how to value a stock, you don't want to know that. Once you know the price, how to react with that price, when to buy, or when do you buy, when do you sell, how do you calculate profit of a stock equity transaction, that would be enough. Like in any other financial instrument, most of the financial instruments, there's a defined and limited life. That means there's a maturity value. The transaction is initiated on a particular date and terminates on a future date. So that is the lifespan of the derivative product, and there's a maturity date for a derivative transaction as well. And very often, payoff, that means as a buyer of a derivative product, what do you get or what do you have to pay is determined on the maturity date. In derivatives, we call it as the expiry date or expiration date. On that date, we decide what is the payoff of a derivative product. But there are instances you don't have to wait until the maturity to decide the payoff. There are instances where you need not to wait until the maturity to close the position or exchange the cash flows or the assets. You can do that before maturity. That depends on the nature of the product that you use. There are some products, there may be interim cash flows. There are some products that the cash flows would occur only on the expiry date. And there are some other products, though there's an expiry date, the transaction cease to exist before the expiry date. It's not a cancellation, but cease to exist before the expiry date. So all these possibilities are there. However, most of the time, payoff is determined on the expiry date. These are few examples. Futures and forwards are very common derivative transactions, and the options and swaps. Basically, we are going to cover these three broad types of derivatives: futures and forwards. Forwards, it may be FX forwards. So indeed, now we have already discussed this, but there may be other forwards, maybe equity, commodity, or any other line, any other underlying. And there's another one called forward trade agreement. So we are going to discuss that as well. Futures, again, it's very similar to forward transaction, but only thing is forwards are over the counter transactions, whereas futures are exchange traded product. Exchange traded products, futures. So that's the main difference between futures and forwards. Otherwise futures are almost same as forwards. So futures and forwards, that can be again based on any underlying, what we discuss. When it comes to the underlying comes to foreign exchange, we call it FX forwards. When it comes to interest rates, we call it forward rate agreements. Others we just call forwards. Those are over-the-counter transaction. Even futures, you can have interest rate futures, commodity futures, foreign exchange futures, bond futures, so many futures contracts. Then options. This gives the buyer a right, but not the obligation. Buyer of the option has a right either to buy some asset or sell some asset. We'll discuss this in detail when it comes to options. Then swaps. These are exchanges. We exchange different interest rates or the cross currencies during a specific time period. So based on the nature, we can classify derivative transactions into two general categories. There are derivative contracts. Both parties have a forward commitment. The party has an obligation to pay or receive something on a future date. So for example, forwards, futures and swaps are fall into that category. Parties have a forward commitment. It's a definite one. Both parties have to meet that obligation. But on the other hand, the other one is contingent claims. The simple form of that is options. So especially the buyer has no obligation, but the seller has the obligation. Buyer has no obligation, so therefore it gives some flexibility to the buyer. There's a flexibility to the buyer, but seller has the obligation. If buyer wants to do something, then the seller has to meet his obligation. But once some certain criteria are met, otherwise even the buyer has no right to make any claim from the seller. It's like insurance. You buy an insurance, medical cover. When do you make a claim? You pay a premium. Yes, you have to pay a premium. But unless something happens, you don't make a claim. That's the option that you have. But if you make a claim, if the claim is in line with the agreement that you had with the insurance company, then the insurance company is bounded to pay you that amount according to the agreement. So the buyer, as a buyer of the insurance, we have some flexibility either to make the claim or not to make the claim. But on the other hand, if the proper claim is made, then the insurance company has to meet that obligation. So it's a contingent claim. If you take automobile insurance, auto insurance, if there's any accident, damage happen to the vehicle, only as the insurance owner we make the claim. Even if there's a damage, if it is very small or minor, the no claim bonus is much higher than the repair cost, we may not make the claim. So as a buyer of the insurance, you don't have to make the claim. It's up to you. In the options also, you have the same flexibility. In this contingent claims, the buyer has the same flexibility, whether to make a claim or not. On the other hand, the seller, insurance company, if a proper claim is made, the insurance company is bounded to make that claim. That is the sort of contingent claims. It's like insurance. But forward commitments, it's not like that. Both parties has the agreement and has the obligation to meet that commitment on a future date. It's nothing contingent. That is a must to do. But in the contingent claims, it is something based on the market condition, whether the buyer will make a claim or not, then the exchange of cash or asset would take place. So this is the basic about derivatives. Any questions? Do you have any questions?
No, sir.
If you don't have any questions, yes, we can move into this to discuss about futures transactions. As I mentioned earlier, futures is a derivative based on that can be based on many underlying. It may be foreign exchange, commodity, bonds, interest rates, or maybe some agricultural products, anything. So there are specific terms that we should know about futures. We'll discuss that. But in simple, futures is almost same as the forward transaction. Only difference is futures are very standardized product and trade through a exchange. So futures is a legal agreement between two parties, like a forward. Even in a forward, that's an agreement between two parties, legally valid agreement. To make, that means either to sell something or take, either to buy something. What is that asset or the commodity that you are going to buy or sell? That is specified. And what is the quantity that is specified? And for goods, there should be a quality. The quality is specified in the contract. And the date when you are going to deliver, or deliver means receive or give it to the other party, that we call settlement date, is agreed, and the price also agreed today. Like I say, the simple example that you know is FX forward. You enter into a transaction to buy dollars against rupee, say on 31st December. Then you specify what is the quantity, say $1 million, what is the exchange rate, say 195 rupees on 31st December. So the settlement date, quantity, and the price is agreed. But if it is like gold or oil or flour or some other commodity, then you have to specify the quality of that commodity as well. That's the difference. But other difference is futures is transferable contract. That means once you buy something, you can sell it to someone else, like a bond. You buy the bond from party A, later you can sell that bond to party B. Likewise, this futures contract, You enter into a futures contract with party A. Later, you can sell it to party B. So you can transfer your ownership to another party. That is possible because it is traded through a exchange. It's not a over-the-counter transaction. It's not just an agreement between two parties. It is very regulated market and work according to a set of rules and regulations. We'll discuss those things in few minutes. So futures contract, as it says, it's not private and customized transaction. You cannot customize the product according to your needs. Say you want something, you want dollars against rupee on 10th September and 1.5 million. You cannot have a futures contract to do that, but you can have a forward contract to do that. In a forward futures contract, the amount and the settlement date is specified. That is specified by the exchange. So because futures contracts are traded on organized exchanges, so these exchanges, they define the terms of the contract. We call that contract specification. That is a standardized thing. In that, specifically say what is the underlying transaction, what is the expiration date, what is the size of a particular contract. One contract is for this amount, say dollar euro. The contract size may be $100,000 or 100,000 euros. Then you have to do the transaction in multiples of contracts, not the amount that you want. If you want to buy gold futures contract may be based specified in terms of troy ounces, 1,000 troy ounces per contract. If you take oil, 1,000 barrels of oil. So one contract, the size of the contract is 1,000 barrels of oil. Expiration date, when to expire that contract, when you should deliver those things, it's specified by the exchange. You cannot decide. So that is the difference between futures and forward. So because of this standardization, it is easy to trade in the secondary market. You enter into a transaction to buy a future with one party, then you can enter into a transaction to sell the same thing with another party. Or you enter into a sale, then you can buy it back from another party. Like a bond, you bought it from the primary market and you sell it in the secondary market. Though in the futures there's no primary or secondary, you can buy it from the market and you can sell it back in the market with two different parties. So therefore the secondary market is there, therefore the liquidity is there. Anytime you can get into the market or get out from the market. So therefore futures contracts are very liquid transactions compared to forward. Forward transactions are over-the-counter transactions, so it's just an agreement between two parties. You can customize it based on your requirement. You can decide the amount. If both parties agreed, you decide the settlement date, everything. But it's just an agreement between two parties. Later, you cannot sell that contract to someone else unless, oh, yes, almost impossible. But you can enter into a different forward contracts with another party. But still, until maturity, you carry two transactions. It's not in the case of futures contract. Once you buy and sell, you don't have any contracts with any of the parties. You just walk away. So when it says the product is standardized, what are the terms? The quantity. For one contract, what is the quantity of the underlying? If there's need to be any quality for commodities like gold, oil, or any other agricultural product, they specify the quality. Then the expiration month, in which month the contract expires, and delivery terms, if there's any physical delivery, to where you should, what is the places of warehouses, to which warehouse that you should deliver your items, or from where you collect it. If you are a buyer of oil, they will specify this is the warehouse in this place. You can collect your goods, oil barrels, from that warehouse. Even in Sri Lankan party enters into futures contracts on oil, we have to collect it from somewhere, some warehouse in Oklahoma, in US. They won't deliver to your doorstep. So even the seller also delivers only to that warehouse. Nobody comes to your doorstep and collect it. So in that sense, delivery terms are specified. For goods that you have to deliver, they give some delivery period, that is also specified. You have to deliver within 15th of that month and 30th of, or before month end, last 2 weeks or something like that. They specify what are the delivery terms, when to deliver, where to deliver, what is the quality, everything. If there's any difference in quality or quantity, what is the tolerable amounts that differentials? If there's more deviations, how to handle that. Then the delivery dates, even though the expiration month is there, say the futures contract is expire on September, that's the month, but they will give you a exact delivery date. This is the last delivery date. You have to deliver before that. And the price fluctuations. You are not allowed to freely change the price. Say the dollar-rupee transaction, usually we use 2 decimal places. But if we want, we can use 3rd decimal place as well. In the domestic market, when we do spot transaction, there may be even the 2 decimal places. We can increase or decrease by price by 1 cent. But in this futures contract, it may not allow. It may be at least 5 cents. Minimum price fluctuation may be 5 cents. Or maybe in the 4th decimal place. They specify that. That is the minimum price fluctuation. You cannot have price changes below that minimum amount. So that is also specified in the standardized terms. Then the other term, daily price limits. What is the maximum price change that can occur within a day? If the price increase by more than 10% or 20%, they will stop trading that. The same thing can happen if it trade low. If the price falls 20% or 10%, whatever the limits that they have imposed, they will suspend trading for that day. So that much standardized and regulated. And they specified during which days that you can trade and what are the hours of a trading day that you can trade the futures contract. It's not open like 24/7, but there are trading days that they have specified and trading hours. Not only that, in the expiration months, they define a date called last trading date. So you cannot trade that future after that last trading date, though the delivery date may be after few days from the last trading date. So for example, this is a futures contract on foreign exchange. On July 5th, 2020, you could have bought September delivery Euro USD futures contract at a price of $1.1316. What does it mean? On July 5th, you can enter into a transaction to buy Euro against dollar at a rate of 1.1316, but you buy it on September. Why it is on September 18th? That is the delivery date specified by the exchange. It's not a date that you decided. It's the date that decided by the exchange, not by any of the parties to the transaction. So if you can visit this site, you can get more details about the specification of this type of contract, euro dollar euro dollar futures contract traded in the ICE exchange, intercontinental exchange. The second example, it gives you about oil. Again, on 5th July, you could have bought December delivery light sweet crude oil futures contract at a price of 59.51. So even in the previous example, price is given per 1 euro. But the contract, when it comes to one contract, it is specified what is the size of a contract. If I remember, I think this is 250,000 euros. The minimum amount that you should buy, 250,000 euros. Then you can buy multiples of that, 250,000. If it is the size of a contract, then you can buy 500,000, then 750,000, then 1 million. Likewise, you cannot have 350,000. It should be the multiples of contracts. For a particular contract, there's a size. So in the oil, the contract size is 1,000 barrels. So when you buy one contract, you agree to buy 1,000 barrels of light sweet crude oil. We call it West Texas Intermediate oil, so WTI oil. You agree to buy 1,000 barrels of oil on December. They might have specified a delivery period. Within that period, you can get it. But you agree to pay $59.51 per barrel on that day. You don't pay it today, you pay it on the expiry date. So very similar to forward contracts. You enter into a transaction to buy something on a future date. But the thing is, it's a forward contract. The difference between forward and futures is other terms are given by the exchange and the market is regulated by the exchange. You cannot customize the product to suit your requirement. The price, that is the only term that can be established by the two parties. This 59.51, that is the agreement between two parties, nothing to do with the exchange. But others, tick size, that means minimum permitted price movements. Okay, now this is a new word, tick size. Earlier I mentioned that there's a minimum price change allowed by the exchange. That is we called tick size. What is the minimum permitted price movement for a particular contract? That is we called tick size. Then the tick value is for a particular contract, if the price changes by the tick size, what would be the value of the change in the value of that contract? If I go back, okay, we'll take this. This is easy. 59.51 4,000 barrels. So price is 59 point. Can you see the board? Price $59.51 per barrel. That's the price. Size of the contract is 1,000 barrels. Size of the contract is 1,000 barrels. Price is 59.51. So then, what is the value of the total contract? That means price into size. Price is 59.51. Size is 1,000 barrels. So 5,951. On the expiry date, you have to pay $5,951 to buy 1,000 barrels. This is the value of the contract. This is the price of a oil barrel. We say price of contract, but the size is 1,000 barrels. So this is the total value of the contract. So now we assume tick size is $0.01. What does it mean? The price can change only at the second decimal place, but by 1 cent on minimum. You cannot change the price in the third decimal place. So from 59.51, if price goes up, that can go up to 59.52. From 59.51 current price, if price goes up, the next level minimum would be 59.52. It can be more than that, but cannot be in between that. That means you cannot have something like 59.515 third decimal place prices. It's not allowed. The price should change at least by a 1 cent. If it goes down, minimum it should be 59.50. The price cannot be in between that. That's the minimum change. We call it tick size. It is 0.01. What is tick value? This is the tick size per 1 unit. But in the contract is for 1,000 barrels. So the tick value is again tick size into size of the contract. Tick size is 0.01 into 1,000 barrels. So the value of the contract would change by $10. If the price moves by 1 cent, value of the total contract would change by $10. So this is the tick value of that contract. Is it clear? So then, based on the number of contracts that you have bought or sold and the number of ticks that the market has moved, you can easily calculate the profit or loss of the contract. You need not to do a lot of calculations like this. Very simple multiplication depending on the number of ticks and the number of contracts and the tick value. So what does it mean by number of ticks? If the price changes from 59.51 to 59.55, price moves by how many ticks? If the tick size is 0.01, how many ticks? Just 4 ticks. That means $0.04. There are 4 0.01s. So therefore, 4 ticks. If the price has moved up by 4 ticks, value of a tick is $10. Your profit is 4 into 10, $40. You need not to calculate the difference between this and multiply it by this 1000. Everything is simplified. Clear? But so just understand what is the tick size, what is the tick value, what is the contract size. Number of units depends on the contract. For a euro-dollar contract, it may be 100,000 euros or 250,000 euros. In terms of base currency, it's specified in terms of base currency most of the time. And the minimum price change, what is the minimum price change allowed? That is the tick size. Then based on the tick size and the size of the contract, you know what is the tick value. So those are the terms. In the contract month, that is the month on which the contract ceases to exist. That means when it is expired. That is also fixed by the exchange. Very often, most of the contracts are matured in March, May, July, September, and December. Most of the time, you can see it's March delivery, May delivery. That's how we specified a contract. Euro-dollar March delivery or Euro-dollar September delivery. So even I think you have seen it. See, December delivery light switch. This is the futures contract. We say we refer it with the month, December delivery. But the other thing is, on the same underline, there may be several contracts trading at a same time. So while there may be a September delivery one, December delivery one, next March delivery, and next June delivery. Likewise. Again, then exchange specified when to start the new contract. So while this December oil contract is trading, they may not open the next 2021 December oil futures. Even for that, they have the rule. What is the first trading date of the of a particular delivery futures? And even within the month, how do you decide what is the last trading date, what is the settlement date? Everything, they are not time to time announce it on an ad hoc basis, but according to a rule. Say last trading date may be Wednesday of the second month of the delivery month. So that is again according to a rule. So if it is the month is September, what is the second week? First you have to decide that based on the calendar, and what is the Wednesday of that week? That is the last trading date of the contract. So everything is defined according to some set of rules, very clear. Anybody can understand what is that. So another example, futures contract 3. This is on July 25th. You could have sold September delivery Euro USD futures contract at a price of 1.1385. If you go back and see the first example, it is a Euro dollar futures contract, but you bought it. Now you are selling it. Both are September delivery. Remember, September delivery Euro USD you bought. In this September delivery you sold. What would happen once you do this transaction? Whether it's a profit or loss, you take that loss, profit or loss, and you don't have any position in the futures. You have covered everything, you squared your position, you book your profit or loss, that's it. Now you don't have any futures contract. But if it is forward contracts, yes, your profit is, what is the profit? It's locked, but still you are running 2 forward contracts until September, until you reach the maturity date. In futures, there's nothing. Once you buy and sell, same thing, it's gone. You have covered everything. You don't have anything to do with exchange or the brokers or anybody. The contract 4 is again the opposite of the oil forward. You sold December delivery at 60.38. You bought it 59.51. Now you are selling it at 60.38. You make a profit. So therefore, what are the advantages and disadvantages of this standardization? So because of this standardization, traders have very clear idea about what they are trading and how much. It is easy. What you have to think about the number of contracts, then you know what is the amount. And there's no broken amounts, broken dates. So very easy to understand and to remember things. So they know, traders, they know what they are trading and what their delivery obligations. It's given in the contract. When to deliver, where to deliver, what are the qualities, and everything is given. If you in any case, if you keep it open until delivery, most of the time you won't do that. If you buy it, you will sell it and you close the position, then you need not to meet delivery obligations. Then it is easy to trade because activity is concentrated in a single contract. Once you know the contract, you know everything about the contracts. So therefore, what you have to do, trade the contract. It is very easy therefore. And because of liquidity and the way that it is set up, it is possible to trade large volumes. So what you have to do trade multiple contracts in a one trade. Instead of single contract, you do, say if you want to buy 1 million barrels of oil, what do? You buy 1,000 contracts. One contract is for 1,000 barrels. When you buy 1,000 contracts, it is for 1 million barrels. That's how you trade it. So it's easy in that sense. And due to standardization, as I mentioned earlier, it provides liquidity in the market and the efficiency. So since the efficiency is there, there's liquidity. Since liquidity is there, the market is also efficient. All the information available will be reflected in the prices, and its prices are transparent. You can see what is the current price of a particular futures contract. It is not the case in a forward contract. You don't know what would be the current price because it's a very customized product. Nobody trade that, so there's no market price for a particular forward contract. But it is not the case in terms of futures. The market is transparent, the product is standardized, the price is visible to the market participants. Then again, few terminologies. We say we are long a futures contract when we buy a futures contract. So contract 1 and contract 2, what we discuss, you are having a long positions. Once you buy, you are having a long position. Then contract 3 and contract 4, if you just take these two contracts in isolation without having previously contract 1 and contract 2, then you have a short position. That means you haven't bought any euro dollar or you haven't bought any oil, but you sell a futures contract to a euro dollar futures contract and a oil contract. Then you have in a short position because you have the obligation to deliver euro with respect to this contract. With this respect to contract 4, this is on oil, you have an obligation to deliver oil. So in that sense, it's a short position. But having the previous contract 1, by entering into contract 3, the second transaction, then you are moving into a square position. That means you don't have any exposure to the futures market. You bought it here and you sold it here, then you don't have any exposure. Even here, you bought oil contract and you sold a oil contract, so the position is square. But assume you don't have this, but you have this, then you are running 2 short positions. Forget about this one as well. You have this, that means you have sold a euro dollar futures contract, then you have in a short position. That is long and short, like any other financial instruments. Once you bought a long, then it becomes a long position. You sell without any exposure, previous exposure, then it's a short position. But you buy something, then you sell something, then you have in a square position. Or you start with the selling, that means you started with a short position, you sell, then you bought, then again you have in a square position. So not necessarily you have to buy and sell. You can start with the sell and later you can buy. That depends on your requirement and the market views, especially if you are a trader. If you want to trade and get the advantages of price movement as a profit, then you may start with a short position and cover it up with another long position, then your position is square. So that is common for any instrument, not only for futures, even a bond, foreign exchange position, or maybe commodity position, anything, or that is common. So equal and opposite positions. So contract 1 and contract 3. As I mentioned, contract 1 and contract 3, if you remember, both are on euro dollar September delivery. So these are equal and opposite positions. And the contract 2 and contract 4 also equal opposite position. Contract 2 is futures contract on oil December delivery. Contract 4 also on oil December delivery, but difference is in this you bought, in this you sold. So equal and same amount, not only different amount, equal and opposite positions. So what does it mean by close out? So if you have an agreement to buy and sell the same item at the same future date and the same quantity, then you don't have any exposure. So once you enter into contract 1 and contract 3, you don't have any exposure in euro dollar if you have done the same amount, same number of contracts. So we call it a close out in futures terms. When you say you close out your position, you enter into a transaction on the opposite direction what you have already had. If you have bought a position, then you sold. If you have sold a position, then you bought. But remember, on futures, it has to be on the same delivery month. If it is a September delivery, the first transaction, the bought transaction is September delivery, then the sell transaction should be September delivery on the same underline. Once you close out your position, you don't have any delivery obligation. You don't receive anything, you don't deliver anything. Basically, you don't have any exposure to the exchange or the any broker, any counterparty. You book your profit or loss and walk away. That is close out. But remember, to close out, you have to be, it should be on the same underline, same delivery month, and same number of contracts. Otherwise, there will be a, otherwise it won't be a close out. So, for example, euro dollar contract, it may be traded in Tokyo exchange as well as Chicago exchange. So then we consider them as two different futures contracts. You can sell it in the Tokyo exchange and buy it in the Chicago exchange. It is considered as, those two are considered as two separate contracts. So you run with two different positions. It's not a close out. If you buy it from the Tokyo exchange on the same underline, same delivery month, you have to sell it at the same exchange, the same futures contract. Futures contract defined based on the underlying, not only underlying, but the exchange as well. So types of futures contract, exchange, the underlying can be exchange rate, interest rate, bond, and mostly stock market index. There can be instances futures are traded on the individual stocks. Then commodity futures, basically the underlying of the futures contract is a commodity. It can be agricultural one, energy one, or metal. Agricultural, maybe grain, wheat, flour, sugar, whatever it is. Energy, maybe oil, gas, even electricity futures. There are electricity futures, even though you cannot store it. There are electricity futures. And metal, it may be gold, zinc, copper, platinum, any metal. It may be industrial metal or precious metal like gold. So this is again example of FX futures on the Chicago Mercantile Exchange, yen futures contract. So here you can see the contract size is not defined based on the base currency, but it is based on the counter currency. The contract size is 12.5 million yen. The contract size is 12.5 million yen. If you buy one futures contract, what does it mean? You agree to buy 12.5 million yen. One contract, you agree to buy 12.5 million yen. If you sell one contract, you agree to sell 12.5 million yen. but the price is quoted in dollars, not in yen. Then the minimum price fluctuation, that means the price can be changed at the seventh decimal place. So now you can calculate what is the tick value. If the contract size is this, if the price change at the seventh decimal place, what is the tick value? 12.5 million into this. What is the tick value? If the price changes by 1 tick, and remember, even though it's in the seventh decimal place, you are not allowed to change that seventh decimal place by 1. You have it has to be multiples of 5. You cannot have a price at the end with the figure 6, 7, 8, something like that. It has to be either 0 or 5. Price change by only 5. And the delivery months, March, June, September and December. Within a year, you have deliveries March, June, September, December. Say you want to buy yen in April or May, you don't have a contract. You don't have any forward futures contract. You need yen in April, not in March or not in June. So you cannot exactly match your requirement using futures. That's the disadvantage of standardization. You may not be able to find the exact match with the futures contract to match your requirement. That is a disadvantage of futures. And the amount also. One contract size is 12.5 million yen, but you need only 10 million. What do? You can't do any futures, so you need only 20 million. If you do two contracts, you buy 2 contracts, it would be 25 million yen, not 20 million yen. So you cannot match the exact date and the exact amount that you need. And this example, it's based on the equity. Based on equity index. The index is FTSE 100 index. This is the UK equity index. That index created based on 100 stocks trading in the London Stock Exchange. So unit of trading 10 pounds per index point. What is the index point? So if you take the familiar example, all share price index. If you go to the CSE site, you might see these days somewhere 5,000, say 500, 5,632, 5,632. This is the index value. This is the index value. What is index point? 1. If the index changes by 1 number, that is the index point. So 5, 6, 32 to 31, index gone down by 1 point. 33, index has gone up by 1 point. So this is the index point. So in the futures contract, what they have done, they have assigned a value to this 1 point, that is 10 pound per point. So from 32 to 33 market moves, that means you get 10 pounds. And the quotations is based on the index points, not in terms of sterling pound. Now the points are 32, 33 or 31. Tick size 0.5 index points. That means you can go for the second decimal, for the first decimal, but only 0.5. 32, then the index can go down by 0.5 index points. That means it can go down to 31.5. It cannot go down to 31.7 because the minimum size is 0.5. The price has to move minimum by 0.5, not by 0.1. So therefore, from 32, the price can go down. Next level would be 31.5 or not 33, 32.5. This is the minimum movements allowed, at least to 31.5. It can be go to 31 straight away. It can happen from 32 to 33, but it cannot have a value in between these two, or 32.5 to 33. There cannot be values in between these two figures, or these two figures, or these two figures. Likewise. Then what is a tick value? If a tick is, sorry, one index point is $10, 0.5, not $10, 10 pound, 0.5 index point, what is the value? It's very straightforward. It's 0.5, sorry, 5 pounds. Tick value is 5 pounds. And again, delivery months are given as March, June, September, December. So I explain all these things just to get an idea about these terms. What does it mean by standardization? What sort of terms are given by the exchange? The contract size, quotation currency, minimum price fluctuation, delivery months. If the minimum price fluctuation or the tick size is given, what is the tick value? And like this. But unfortunately, in Sri Lanka, we don't have any futures contract. So therefore, we have to go by these international examples. So you may need some knowledge on these markets. In the third one, the third example is interest rate futures. Remember, this is an interest rate future, not an exchange rate future, though it named as euro dollar futures. It's not euro against dollar futures contract. You may remember I mentioned that if a dollar deposit is made outside US, we call it a euro dollar deposit. That's the concept that is used here. So dollar you lend or borrow, but outside US. Again, contract size is specified, currency, in which currency the prices are quotes and values are calculated. It's US dollars and cents. Price quotation 100 numerical value of the rate index. So in contract size, there's something called rate index. Based on that index, the contract size is defined. Not only that, price quotation also based on that index in 100 numerical values. Then the tick size is 0.25 basis points. Again, contract series March, June, September, December. Different futures may have different deliveries, but some of the delivery months are very common for a particular exchange. Then when it comes to commodity futures, again, oil futures, we call it WTI futures, because there are different sort of oils. You might have heard this WTI is the very famous one in US, but in UK, it's not WTI, it's called Brent. So this is UK market. UK market, they trade Brent oil. In US, they trade this WTI. In Sri Lanka, we get something else. We don't get WTI or Brent oil because the quality standards are different from different products based on the technology that they use to extract oil or the quality of the oil well. So that's some technical thing related to oil, but however, two different oil. Though both are crude oils, the qualities are different, so therefore they have given different names and different futures also trade based on that quality. So if we concentrate on the WTI futures, West Texas Intermediary futures, oil futures, contract size is 1000 barrels. Currency is US dollars, tick size is 0.01. So then again, tick value would be, as I calculated earlier, it's $10. Very easy. And the contract series are there up to 108 consecutive months. So that means every month there will be settlements. Now it's July. There's a July one might be now maybe already expired. There may be August, September, October, November, December, January, February, likewise, but up to 108 consecutive months. That means how many years? It's about 9 years. So there may be December deliveries, 9 December deliveries, 9 in December in 2020, December in 2021, December 2022, likewise. And the settlement is cash settled. This is again something that we have to pay attention. What does it mean? Settlement of a futures contract, there are different ways. One is we call cash settle, other one we call physically settle. In a cash settle transaction, you don't deliver. So in this example, 1000 barrels of oil. If you buy, you don't go to you don't send a ship to that warehouse in US and get 1000 barrels. You don't collect 1000 barrels when it says cash settle. But what do you do? In our example, we bought it at 59.51. There's thing called, if you hold it until the last trading date and until the end of the last trading date, then you are subject to delivery. So assume the closing price is 60. The last traded price of this futures is 60. Basically, this should be the spot price of that date on the oil. You don't get 1000 barrels of oils and you pay $5,951 to get 1,000 barrels. Instead, what do? We calculate the difference, that is 49 cents, and for how many barrels? It's for 1,000 barrels. So you basically you receive $490 because the closing price is higher than the price that you agreed. So you make a profit. So you receive this cash amount. You don't pay $5,951 and collect 1,000 barrels. You don't do that. But you get the difference between your buying price and closing price. You receive it if it is a profit. If it is a loss, you pay it. So that is we call cash settle. In physical delivery, you get 1,000 barrels and you pay the required amount. That's the difference between cash settle and physical settlement. So you can see how do you settle the transaction is also given in the contract according in the specification. So it says this commodity futures settle cash. That means if you really want to buy oil, buying this, it won't you won't get oil, but it will help you to minimize your cost. That's different thing. But you won't get oil. You have to buy oil from somewhere else. Is it clear? What is the meaning of cash settle? So we'll stop here. Again, I request you to visit this website that I have given here and go through the specification of each and every contract. Get some idea about these terms. Contract price, contract size, currency, minimum tick size, tick value, and in some contracts there's a index point, index, rate index. So get to know about these things, then we can move forward and discuss this, how to calculate profit of a futures contract, profit or loss, and draw the payoff diagrams and discuss about questions. So with that, we'll stop here. If you have any questions, you can ask. So by next week, please revisit these things and get some idea about what is the tick size, tick value, contract size, and things like that. Because to calculate the profit and loss, we just use those. We don't think about whether it's euro, dollar, whether it's oil. We don't care about it. We just consider the tick size, tick value, contract size, things like that. To calculate the profit and loss, the jargons we use would be different from the ones that we used in other products. That would be depend on the contract size, tick value, tick size, things like that. Index points. So be familiar with those when you join the class in the next week. So if you have any questions, please, you can ask questions. If you don't have any questions, we can stop here. So then see you next week. We'll stop here.